Hello, everybody. It's me, Michael. You're watching the Stock Market Brief Show, where we navigate the financial markets through the lens of technical intermarket analysis. It is Monday, March 25th, and it is a shortened week. Friday, the markets will be closed for Good Friday. And the question that we're going to try to be answering here is, are we going to be getting that window dressing, or also known as month-end markup or quarter-end markup into the end of the month? So we're going to kind of build out the case for some of the things that I'm seeing here and what we could potentially look at for as far as risks, but upside too on today's market brief. Before we hop into it, make sure to check out the links in the pinned comment or the description. One will be to my Patreon community. Patreon community, I actually don't post on Patreon. I post everything there on the Discord, which has all kinds of fun benefits. I plan on updating this here soon, but it's only $9 a month. I do things like the weekly expected moves, daily expected moves. I do the zone document, some of the indicators that I share here, the permalinks to these charts that I use, trade ideas, which are just, this is not an alert service by any means, in my watch list. And I also include my tight list too as well, which are all the stocks that are contracting within my watch list. And then you have all access to the Tradie Ticks bots there too as well. Yeah, just all kinds of stuff. Let's go ahead and get into today's episode. All right, welcome back to the show. Looking at the 11 sectors that make up the S&P 500 and the index products over here, we had a down day today, but it was rather unchanged. Right, remember, this is a holiday week, okay? And we're coming into month end, right? This is typically where volumes could dry up, and they're a little bit easier to manipulate as far as going into those month-end markets or potentially sell-off. So we got to look at both cases here. Energy caught the big bid today, and utilities was the second performing, and then technology had the weakest. It was the weakest performing sector. And I mean, if you just take a look here, the market wasn't even down that much. Like, take a look at the S&P 500, down 31 basis points. And the big fall came towards the end of the day anyway. And what are we looking at, right? Microsoft was down, Apple was down, Google was down, Meta was down. All the big mega cap names were, but what wasn't? Well, NVIDIA, right? NVIDIA was up almost 2% on the day it came off the highs. And then Amazon was up slightly more than that, but that's finished up a 0.5%. And then, yeah, Tesla too as well. But what kind of effect does this have on the market as it stands right now? Not much of any. It's more these big ones, the big dogs over here. Okay, and then you can see over here in the energy section, a lot of green on the screen over there. So NVIDIA, once again, is still an important one to watch. And if I pull up a chart of NVIDIA, you can see that we had this downsloping trend line, right? Price action got tight within a bullish context. Yeah, we saw this bearish candle, but we broke from that and we pushed higher. We're nearing that 1,000 marker, right? Can we get there this week? Maybe, perhaps, right? Sometimes it's likely to consolidate again to make the move. That would be actually quite healthy. But it looks like we're trying to come and actually retest that prior swing high. So we'll see if that's the case. If the market wants to pull down a little bit, which makes sense, we are still above a rising 5-day moving average on the price of NVIDIA there too as well. You can take a look at semiconductors, and semiconductors, right, has been on a monster tear. But even when we had this big day to the downside that followed through to the downside, it was just ends up being a consolidation, and we gapped through that, and now we're consolidating here some more. So are we going through a longer period of building a base? That's always a possibility. If you take a look at Amazon's been kind of floating around the 180 marker, also in bullish context with the 20 and the 50 and the 200-day, all good spreads between them all, and it's all kind of just trading up a little bit higher. So I have a position in Amazon. I'm looking to trade it up. One way to measure this is just by looking at the consolidation, or I would even go smaller, right? Smaller consolidation, or they call this a potential Darvis box. And then you would measure the width of this box up, so basically to around 190, and that would be a technical measured move where it's like a 1-for-1 risk to reward ratio on a breakout of that 180 marker. If you take a look at Microsoft has also broke out of this consolidation pattern, right? It broke out, it pulled back, and then it went for a monster tear. And now, since after the Fed meeting, it's pulling back slightly here, almost reaching around to its lower weekly expected move already on day one. Not quite reaching to it yet, but it's in bullish context, still saying to me that the door's open for the gray box up here. So we'll see if that month-end markup, quarter-end markup drives price even higher, right? The saying is strong stocks get stronger, weak stocks get weaker. And if you thought this was the high, you were wrong. If you thought this was the high, you were wrong, right? You can go back. You thought this was the high, you were wrong. If you think this is the high, there's a high probability that chances are you're going to be wrong again, right? So what you really want to see when things break, right? Yeah, you can look through periods of distribution, so that's signs, but then you want to see the shorter term moving averages start to turn around, and then the medium term, and then obviously the longer term there too as well, which we're pretty far off of. Take a look at Meta. Meta broke through this little consolidation over here too, and now we're pulling back ever so slightly, but we're above a rising 20, 50, and 200-day moving average there too as well, saying that the door is still potentially open to retest this high and potentially swing higher. Will it do it? I don't know, but that's just the case right now. It's going to be hard to take down this market. It's going to be hard to change these trends because they're not going to go down without a fight at this current moment. Now, if we look at Tesla is a different story, right? This has been down all year. It's been getting beaten up. So perhaps, hey, like, are we going to see a rotation into this at some point? There's a possibility. But if I look at this, and if I look at this actually on our stream today, we talked about it being inverted and it looked bullish, right? You can look at like, hey, there's a bull flag, right? Because it was inverted. Bull flag, we broke out. And then we're flagging again, right? This is going to break out again. But there's also a way to look at this where you can say, well, actually, we might get somewhat of a bounce. Why? Well, we pulled down right here, right? Pretty strong pull down. And you can see a low, a higher low, a higher low. We connect those. And price action's kind of contracting, right? We kind of tightened up in this area. And I don't have the MACD or the RSI, but this was actually the indicator itself was putting in a higher low, telling us that the internals are a little bit stronger here. And the price action got weaker, so it's likely we can get a bounce. And well, we got that bounce, and we saw a little bit of strength today. But overall, just understand that the trend, it's still bearish. So yeah, you can catch moves to the upside, but that doesn't mean you're free and clear all the way, right? If you thought this was the low, or if you thought earnings was the low, well, you would have been wrong. You would have been happy for a little bit, but then you got smashed, right? So you got to be at least a little bit more tactical looking at these type of trends. If you take a look at Apple broke that 180. We came down very hard and fast, and we saw a reflexive bounce. Guess what? We came down hard and fast on some news, and we're getting some continuation there to the downside, including today, but well off the lows. So to see this bounce too could be a potential setup, could be a short-term trade, but just understand that you are breaking this one, you are actually breaking the 200-day, the 50-day, the 20-day, and they're starting to point down, which creates a more bearish scenario the longer we trade down here, right? If we don't take out this high and we start making new lows, I mean, we have a high, a lower high, a lower high, a lower high, a lower high. I mean, even if we were to come up there, you might consider that a potential double bottom, but you would be fighting a 50-day declining moving average. You'd be fighting a 200-day that would be starting to turn over here in the near future. And that could be a pretty bad stance, as we also broke through a heavy area, that 180 level. We try to come back and test it, right? Once resistance is broken, once support is broken, it could become potential resistance, and we kind of saw that there. If we take a look at the 11 sectors that make up in the S&P 500, take a look at XLY. So XLY, we broke out of this wedge, saw a strong move, and now we're pulling back slightly. So once again, it's a pullback within bullish context. XLC, right, kind of looks like the Amazon chart, right? We broke out, and we're pulling back there ever so slightly. We're off the lows. And then technology is kind of going sideways here, pulling back slightly, but it could be considered a bullish consolidation. XLI is pulling back a little bit. This one's just been kind of a one-way ticket up. XLB, same situation. XLE, same situation. XLP, trending up here too as well. A little bit more chop than the other products. Healthcare is still consolidating, so this one to me is getting pretty tight. Look for a move. If we start breaking above the 146, that can create a move to the upside. Utilities is starting to tighten up here too in the short term, and this would be considered more of a defensive sector, but this has also been moving up, and you can see these last 3 trading days, the ranges are getting tighter and tighter, meaning that most likely we'll see an expansion in the price action range in the very near future. And then financials, we saw a pretty strong move, and that's getting faded ever so slightly here, but still in bullish context. And then real estate's been kind of going sideways. Now, one thing that I want to call out here that you might just overlook completely is the volume on all of the sectors. What do you notice? You're seeing a decrease in volume since the breakout, right? So you consolidated, you break out, right? But volume's all drying up here, even including today on some of these names were much significantly lower volume. All right, you see declining volume on XLB, declining volume on XLI, declining on XLV, and so forth down the list, right? XLY, XLC was a little bit more of an uptick in volume today, but still declining. And then look at technology. Technology is an important one to call out because we just said a lot of those names are in bullish context. And even on today's down day, I mean, the volume was minuscule, right? So it wouldn't be considered a distribution day, which tells me once volume dries up, just like price action consolidates or pulls back, that opens the door for an expansion in volume and a potential expansion in price that could very well be bullish. And if we take a look at the SPY, right, we haven't had a pullback like we've had a pullback consolidation like the prior year where you had a 9% correction here, a 10% correction there, and we've basically pulled back maybe up to like 2.5% so far on this big run up. And right now we're seeing a little bit of a pullback after seeing a pretty massive breakout. So if I zoom in, you can see this a little bit better. You can see the price action was kind of going sideways or like this in bullish context. We broke out, right? The breakout came on some expanding volume. And then what you can see here is we're pulling back ever so slightly. This day got a little bit extra volume, but we're pulling back pretty calmly here after breaking out. So even if we were to pull back, this could be a back test of a potential breakout or a back test 517.50 of a potential breakout. Now, one thing that I wanted to call out here was this specific chart looking at gamma exposure. And what you'll notice here is we have a new call wall. That's 5,300. We've been talking about that potentially growing in size. So this tells me that traders are reaching up further out on S&P 500, meaning they're reaching out to 5,300, right? It was 5,200, and then it was 5,250, and now it is now 5,300. So when price was moving up into and around that 5,250 level or 5,200 level, you can see price actually moved up and it kind of got pinned around in these levels. Then it was right till this point where the Fed came out and that perpetuated price up higher. And that, I don't know why the levels aren't on my chart. This is 5,250. Sorry, this is the 5,200. So when 5,200 was the call wall, price moved into this and around these areas. It's actually 5,190. 5,200 was slightly above. Then the Fed came out, and that's when we started to see the structural change here from the call wall. So not only are we seeing the call wall at 5,300, but the gamma flip line has moved up to right here, which is 5,220. I don't know why the numbers. I must have cut it off for some reason, but that's fine. You'll see the numbers here on the S&P 500 chart in a moment. But what we're looking at here is really just a bullish consolidation. Also, it's not like it's a steep pullback by any means. It's kind of just trending a little bit lower here, but we're still in positive gamma territory in this current moment, which means that dealers are looking to buy the dip, sell the rip, right? We got the rip, we sold into it. Are they looking to buy the dip? Well, they did right here at the gamma flip line. So we'll see if it actually can hold. If it doesn't hold, that's where dealers look to sell into selling, buy into buying, and you may get a back test into and around this 5,190 to 5,200 level if we're getting to get a little bit more of a steeper pullback going into the month end or quarter end. Okay, so if we take a look at the SPY on the 15-minute time frame, you'll see here a couple of interesting things. We're above a rising 5-day moving average, right? Positive gamma territory, rising 5-day moving average. That's check for the bulls. What I do find interesting today is on the gap down, right? We had a decent sized gap down today. And what you'll notice here is if I anchor to when the Fed talks, so we'll call this the JWAP, right? The Jerome weighted average price. It's the same thing as the anchored VWAP. You'll see that we gapped down and we actually held beneath that level. So if you are more bullish and you want to break this, consolidation, I would say it'd be important to get back above that, or you can even anchor to the swing high and it's probably around in the same area and you'd want to see that recouped. So as it stands right now, if we start pulling back steeper, and even if we get back to the weekly EM, the expected move for the week on SPY, which is 515.74, that would be pulling into and around probably the month-to-date anchored VWAP, and you'd be pulling into this down-sloping channel breakout right here, which we just previously discussed, right? Resistance, resistance, resistance. The Fed JWAP, we broke out. So even if we pull back further, it could just be overall a back test. Now, it doesn't mean you buy that, right? You want to look for strength. You want to see a higher high, higher low, and then go from there. But just remember, if the 5-day moving average turns around, right, and starts declining, and we're below it, that's when you're going to be big. You want to first, if it gets below it while it's inclining, you be bearish with caution. But if it starts rolling over, that's when you got to be a little bit more careful. All right, less so. I mean, you want to be careful all the time, but in positive gamma territory, and we're above a rising 5-day moving average, you look for more bullish setups versus necessarily shorting, given the current trend right now. Now, going into the rest of the week, we don't have really too much stuff going on, right? We have durable goods tomorrow, some S&P numbers. The next day, we got, some Fed talk. Then we get some GDP numbers. We'll see. And then Michigan consumer sentiment final for March. So we'll see here if that, I'm assuming just to have an idea when those drop if you're trading intraday, because it will bring volatility. But volatility has come off quite a bit when I'm looking at the daily expected moves, the weekly expected moves, right? The daily expected move today on the SPY was only $2.12. And on the week, albeit the week is a shortened trading week, but it's only a $53 expected move for the SPX. The week prior was 80. The week prior before that was 78. The week prior before that was 78 as well. The week prior before that was, I'm looking right now, 63, right? So this is a very, very small, like implied, like expected move for the week. Okay. If we continue on, I wanted to look at a couple intermarket assets. So the 10-year yield looks like it's just putting in a higher low right now, right? We have a low, a higher low, and right now we're seeing some strength in it today, which could be a cause for potential some of the weakness. But I was like thinking to myself, I'm like, well, let's pull back up a correlation chart. So if you look at the SPX, and we're just looking at the long-term treasury yield, the correlation between the two. And you'll notice that these are 10 days and 30-day correlations. This is not my typical chart, but I'll pull up my typical chart another day. This was just easier to pull. But where we stand right now is right around the zero line. So there's not really a strong correlation. What you'll notice here is there's typically spends most of its time in negative territory, meaning that there's a negative correlation. So if these longer-term yields, they start to rise, it could put potential pressure on the S&P 500 or some of the heavier growth names. So my thought is if we do get a quick pop or even up through this, it may hurt some of the names, but the correlation hasn't really resolved itself to be really negative. There isn't, on the shorter time frame, much of a correlation at all. And then if you take a look at crude oil's rise kind of hints that the 10-year yield could very well move higher, right? There's a tight correlation between crude oil and the 10-year yield, and crude oil broke out from here, consolidated. We pulled back a little bit, and on this little pullback, we said this is probably an opportunity, all right? And we saw some follow through today on some decent volume. So we'll see here if there's a follow through here, which will lend hand potentially to a rising 10-year yield and also even some various energy names themselves. If we take a look at the dollar is also kind of just trading sideways right here, but holding somewhat of a defensive posture. If we get a big hit to the dollar, as far as like a rising dollar, that can put pressure also on multiple assets that we've seen. But this year, that correlation between the dollar and the S&P 500, was once negative. Like that's what really caused this entire move in the S&P 500. If you look right here, this move right here to the end of the year came from a falling dollar, right? Look at that. From October to here, a falling dollar. What did the 10-year yield do? The 10-year yield also fell too. So we had a falling yield, falling dollar. That just made the markets move. This year, this is rising. The dollar's rising, right? But there is really no correlative state right there. So it's just overall a very interesting kind of situation. Now, if the dollar does fall, that can really perpetuate gold move to the upside. And gold, right, we had this very strong, big base breakout, very strong follow through, tight consolidation. Boom, we just hit another all-time high, right, in the price of gold, and we're pulling back here. So this is still pulling back, consolidating in bullish structure, opening the door for potentially higher. And if that's the case, maybe the dollar does come off a little bit there too as well. And then take a look at Bitcoin. Bitcoin was up massively today, breaking out of its pullback. So you can see we pulled back pretty significantly over here. Bitcoin's a pretty volatile asset, but today we saw some massive follow through. If I take a look at the Sailor to Shift tool, the Sailor to Shift tool is still on the buy signal, buy trigger, and price action continues to move up. What happens is if this crosses below the zero line, and it not only crosses there, we have to have the rate of change hold under there for the week. So it has to close under there for the week when the new weekly candle forms. And that is the sell signal. But that doesn't necessarily mean that there's going to be a sell trigger. The sell trigger is part of the strategy that I put together. And that is when whatever that week closes at, if the next week closes or crosses below the low of the prior week, that would be the signal, then the trigger. That would be the trigger. So that's what we would be watching for. But as it stands right now, it's just not there. So we'll follow up on it. I just wanted to do a quick update. So what are some of the risks, right? We talked about the gamma flip line, the 5-day moving average potentially turning around. I want to talk about the volatility chart because I find this to be very fascinating. The Bollinger Bands, they are contracting so darn tightly right now. It keeps on getting tighter and tighter every day. So I keep on updating this line, and you can just see that the Bollinger Bands, right, the price action, or I guess you can call it price action of the VIX, is getting very tight. So the Bollinger Bands are getting very tight, and it doesn't hold down there for long, right? This is the tightest it's been since like 2004, 2003. That's actually coming out, I believe. I forget the exact time, but I believe the VIX actually broke down further and further and further at that point. But prior to that, the time it was this tight was in 2007, going into and around the great financial crisis. Now, I don't know if that's going to be the case by any means, but what I am calling out is this won't stay down here forever. It's going to expand, right? It contracts, it expands, it contracts, it expands, it contracts, it expands, it contracts, and it expands, right? So we're watching this one closely because if volatility all of a sudden starts to pick back up and this expands, is volatility going to expand to the upside where we get a quick pop? The Bollinger Bands are going to start to reopen up. Perhaps that may be the case. So that is one of the concerns here is volatility's kind of just been, and a lot of people are saying the VIX is pointless, right? I get that to an extent because now of the 0-date trading. So we kind of incorporate it still and we still look at it. I still find it important, especially when you're trying to look at things from periods of contraction and expansion. Another indicator that I find interesting is the old full indicator. And this is taking the NASDAQ composite and dividing it into the put to call ratio. And I did see a big spike in the put to call ratio. So that we see this spike down to the downside, which is going to cause this indicator to pull down. Now, this isn't updated yet. We talked about it on this day when it was getting pretty tight, but it didn't cross. I'm just bringing it back up because it's getting tight again, tighter than it was prior. So if this is the case and we see that this actually crosses over, it could initiate the starting of a sell signal on this old full indicator. Now, the last buy signal took place over here in November, and that was after this gap up, basically breaking here. And then since then, it's been on a buy signal going all the way. So this is a lagging indicator, but it can identify a potential stronger change in trend perhaps. So we'll watch it, right? That's the thing. And you can get whipsaws and all that stuff. But the last sell signal was over here in August, and you can see the market pulled back some, and then it got this sell signal. It went down lower, but it also went right back up, going above this prior high. But this never changed, right? This never changed. So we actually went up, we went back down, we went up, we went back down. And it wasn't until we actually saw some more strength and this started to cross over where we got some really good follow through there. Another thing of interest is just how steep these trends are. And I'm bringing you the line chart for the SPY just because to give you an idea of just how tight this price action's getting, and this is the thing with when volatility subsides, when volatility comes off, you typically get more up days, but they're smaller, right? So if you pull back a little bit, you get buys, and it does this. This is the type of price action that you really get. So you get an explosive move, breakout, and then volatility is contracting, and you get these small grinds higher. The problem here is when volatility steps in, you can get a crack, and it could be a very dramatic day, a 2% day to the downside, wiping out 7, 8, 9 days of price action, right? If we had a 2% down day, you'd look back to the left of the screen and be like, dang, we were trading over here back in February, right? So that would be more of the risk aspect of it. Now, like I said, we're coming into the month end, quarter end. We've seen markups before. It doesn't guarantee anything, but that I think we've seen a lot of pullbacks in bullish context. So I think it's opening the door for that possibility as we're holding the gamma flip line, as we're above a rising 5-day moving average. I think it could potentially make sense, but there are still risks. Volatility is contracting. Old full indicators starting to turn over. The trend line here, the price actually getting very, very tight, and we're getting negative divergences in things like the RSI. And even if you look at the NYSE composite, take a look at the NYSE composite. This thing is crazy. This thing has just been straight up, and look at these pullbacks. They're very, 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 very shallow and low kind of grind higher. So when volatility wants to enter its face in here and say, what's up? It could shock some people, and I'd prefer to just get people aware of that because you don't want to be like doing really well and all of a sudden you're way too levered up, right? And then all of a sudden you have like a 6% down day in your portfolio because you're just way over maxed on the beta of a portfolio, right? And you're not paying attention to all these small little critical things taking place. If these trends break, the concerning thing is when I looked at that gamma is there's not really anything beneath us, right? So 5,300, they're reaching for that, but there's not like much stability beneath us that like going on, right? Our call wall is roughly at 5,000, and there's not like anything that stands out here. So if we do start to crack lower and then look at CTAs, they're basically maxed out here. This is, think of momentum traders. And if we get some sort of downwards convexity, I mean, it could get pretty gnarly pretty quickly. So I think it's just a matter of being aware We know where we stand relative on the smaller time frames. I like to use the 15-minute. You can use the 30-minute, 65-minute. You can use whatever you feel comfortable with, or just watch the direction itself of the 5-day moving average, and then be aware when we start cracking the gamma flip line. That's all I really got for you on today's episode, everybody. It seems to me the market's wanting to reach higher. My target is up to 5,300, and then maybe I'll start to reduce more. Till then, I'm looking to add until the market changes, until it tells me to start reducing once again. That's all I got for you. See you later.